few years ago, I met a couple who had built their entire retirement plan around dividend income. Every month, they'd see those deposits roll in from their stocks, and it felt like everything was working perfectly. It gave them this incredible sense of stability. They'd tell me, Adam, it's great. We don't touch our investments, we just live off the income and let the rest grow. But then the pandemic hit. Within a few months, three of their biggest holdings either cut or suspended their dividends. Now, overnight, they lost nearly 20% of their retirement income. And it wasn't because of anything they did wrong, it was simply because they were relying on something that they couldn't control. Now, I did a video recently comparing dividends versus withdrawals, but today I want to dig deeper into this idea of dividend dependence because it's one of the most common and overlooked risks that I see in retirement. So if you've built your plan around dividend income, well, this one's for you. I'm not here to talk you out of it. I'm here to help you understand the hidden risks so that you can protect yourself before those risks show up. Now, let's start with why this strategy is so popular in the first place. Well, dividends feel safe. They show up like a paycheck. You don't have to sell investments, and psychologically, that feels great. It feels like your money is working for you, not the other way around. Now, there's something deeply comforting about it. You've spent your whole life working and watching paychecks come in every 2 weeks. And dividend investing recreates this same rhythm. Now, that's why so many people get hooked on it. It's not just about the money, it's about the feeling of consistency, the emotional security of knowing something is coming in no matter what the market is doing. But here's the problem. Comfort and control aren't the same thing. Because while dividends can make your income feel predictable, the reality is that you have no control over whether those payments continue, increase, or completely disappear. And for a lot of retirees, that illusion of safety can quietly morph into one of the biggest risks in their plan. The first big hidden risk of relying too heavily on dividends is overconcentration. Now, if you look at most Canadian dividend portfolios, they all start to look the same. Banks, pipelines, telecoms, utilities, maybe sprinkle a REIT or two, maybe some energy companies. And to be fair, these have historically been great sectors, but they're also cyclical, which means when one of those sectors takes a hit, your entire portfolio feels it. Let's take 2020 as an example. Oil prices crashed, and several large Canadian energy companies that retirees depended on for income, either reduced or suspended their dividends. Now, for most people who were counting on that cash flow, well, they suddenly had to start dipping into savings just to cover your monthly expenses. Now, diversification isn't just about how many companies you own, it's about owning different kinds of income sources. Now, when all your income comes from a handful of sectors, you're not diversified. You're concentrated in comfort. And that's what makes this one tricky because emotionally, it doesn't feel risky. It feels stable right up until it's not. The next hidden risk is chasing yield. Now, I see this one all the time. Retirees will start looking for higher and higher dividend yields, 6, 7, even 8% or more, because on the surface, that looks better. It's the more income, less selling mindset. But what most people don't realize is that higher yields almost always come with higher risk. Sometimes it's because the company's stock price has fallen, so the dividend looks big in percentage terms, but it isn't sustainable. Other times it's because the company's paying out more than it's actually earning, which eventually leads to a cut. And when that happens, not only does your income drop, but the stock price usually drops too. So you lose both the income and the capital value. Now, chasing yield is one of those things that feels smart, but is really just another form of emotional investing. It's driven by the desire of more stability, not more return. Now, let's talk about the tax side for a minute, because this is one of the most misunderstood parts of dividend investing in retirement. Now, we always hear that dividends are tax efficient, and that can be true. if you're in a low enough income bracket. But if you're drawing CPP, OAS, maybe a small pension, and you're earning dividend income from a non registered account, that efficiency can backfire extremely fast. Now, you're probably asking why. Because of something called the gross up. Now, when you receive eligible dividends, the CRA pretends that you earned 38% more than you actually did. Now, that inflated number is used to determine your income for OAS clawback and tax bracket purposes. So, even though your tax owing might not look huge, that grossed up income can push you over the OAS threshold or into a higher marginal tax bracket. Now, I've seen clients lose thousands in clawbacks simply because they didn't realize that their dividend income was being inflated behind the scenes. So, yes, dividends can be tax efficient, but only when they're managed properly within a controlled or coordinated plan that looks at all your income sources together. Now, here's another thing that most people often don't think about, and that's inflation risk. Now, most dividend paying companies don't increase their payouts every year, or at least not fast enough to keep up with inflation. So, over time, your purchasing power erodes. That $2,000 a month in dividends that feels comfortable today might not cover the same expenses 10 years from now. And here's where it gets worse because when you're focused on income, you often end up sacrificing growth. Now, dividend heavy portfolios tend to exclude growth oriented companies, the tech innovators, the global disruptors, because they don't pay high dividends. So you end up with a portfolio that's income rich but growth poor. It pays you now, but it doesn't keep up with your life later. Now, the irony, you traded future security for present comfort. Now, let's go back to the couple that I mentioned earlier, the ones who lost 20% of their income overnight. Now, when that happened, the hardest part wasn't just the financial loss, it was the feeling of helplessness. They said, we did everything right. We picked stable companies. We didn't panic during market dips. How could this happen? And that's the hidden risk that nobody talks about, the loss of control. When your income depends on dividends, your financial well being depends on decisions made by company boards. They decide how much you get paid and when. And that's fine when everything's going well, but it becomes a real problem when things change. Now, with a withdrawal strategy, you decide when and how to take income. You control the flow. Now, with dividends, someone else controls your paycheck. And for most retirees, that loss of control is far more stressful than a bit of market volatility. So, what's the answer? Do you avoid dividends altogether? Absolutely not. Dividends can be part of your income plan. They provide stability, predictability, and a little bit of emotional boost that's going to come with seeing that cash flow. But they should be part of a bigger plan, not the plan itself. Now, when I work with clients, we focus on total return planning, blending dividends, interests, withdrawals all together into one coordinated income stream. Now, this allows you to decide which accounts to draw from each year, how to stay under certain tax thresholds, and how to keep your investments balanced between income and growth. It's not about chasing yield, it's about creating flexibility. And that's the real definition of retirement security, having the ability to adapt as your life and world changes. Now, let's come back to the word safe. Safe doesn't mean selling an investment. Safe means being prepared. Safe means having options. Now, I think a lot of retirees confuse predictability with safety. Just because something looks steady on the surface doesn't mean it's secure underneath. Now, when you build a plan that's flexible, one that includes different income sources and strategies, you're not just protecting your money, you're protecting your peace of mind. And that's the kind of safety that actually lasts. So if your retirement plan leans heavily on dividend income, take some time to review it. Ask yourself, am I diversified enough? Do I understand my tax exposure? And if those dividends were cut tomorrow, what's my backup plan? Now, if you're not sure, that's okay. because most people aren't. That's exactly what we help clients with and figure out every single day at Stone City Wealth: how to build a retirement income plan that's balanced, tax efficient, and built to last. Now, if you'd like to learn more, feel free to visit us at stonecitywealth.com. I'm Adam. Thanks for watching. We'll see you in the next video.